I'm so glad everybody's here, and again, thanks for being here and welcome. So what we're going to get into today is from confused, confident, dominate any market. So we're going to go through a lot of really cool option strategies, some of my favorite go-to type strategies to give you an idea of what they are. So what I call the uh, option strategy confusion, OSC. So I'm glad you're here, and hopefully this will be a great workshop for everybody to learn a whole lot. And make sure to get your notepad and your drink and let's get rolling. So anyway, to give you a little background on myself, I've been actively trading options now for over 30 years. I started my trading career actually back in the 80s with a company called Coastal Corporation out of Houston. And they actually, at that point in time, they had a training program that if you got into it, they would train you or teach you how to trade crude oil and oil products and stuff like that. So fantastic experience. I was able to get my foot in the door there. I remember the boss said, he said, if I tell you to wear a green suit, wear a green suit. It was that kind of situation back then. But anyway, a great place to start. They sent me down to one of the refineries. I had a big refinery down in Corpus, Texas. Sent me down there for about 3 months, and it was a really great experience because what it gave you the fundamentals of just kind of the basics of the oil industry and how it works. So bringing in the oil tankers into the refinery there in Corpus, offloading the crude oil, putting it through the distillation towers, putting out the different products. So kind of learned a whole background of that. So that was fantastic, kind of foundational start to my career. And then ended up into the tanker department, scheduling tankers and all that kind of stuff, operations, which was a great experience. And then finally got, on the trading desk, the cargo trading desk for crude oil. Sent me out to Singapore for a couple of years, traded oil out there and oil products, which was a great experience. So beautiful city, fantastic food. If you ever get a chance, check it out. And then got a great opportunity, was able to go to work for a company called Transworld Oil. It was a kind of a Dutch-owned trading company, and I spent about, 18 years there. And they sent me out. I ended up in Bermuda for about 16 years of that. So spent 16 years and then ended up running the international trading desk out of Bermuda for 10. That was a corporate headquarters. But at Transworld, it was at that point in time, it was one of the largest oil trading companies in the world. It was Transworld, Markrich, and Fibro. And so we were really big in all the energy, everything from natural gas, to crude to products, you name it. And but we eventually got into all the other type of commodities and futures and foreign exchange, and then option trading. Started that back in 1987. Doing option cargoes, selling options on cargoes of crude. So it was a fantastic learning experience, seeing all the different variations in the markets, all the different things that would happen. But the experience of starting to trade options, that's where it really all started for me, and never looked back. So again, let's get rolling, and just a little background on myself. So the following workshop today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. Now, the secret of trading profits, for me is really, comes down to options. And when you look at trading is a business of probabilities, and to be a successful trader, controlling your risks is what's really going to win the game for you. So knowing and better understanding then how to manage and control your risk is going to make a dramatic and positive difference in your trading performance. And really one of the best ways to do this is through the use of options in your trading. Now, trading options, they have so many more advantages than just trading outright stocks, but they can, be confusing and debilitating to traders or investors unless you really know which option strategy to use and when and how then to use it correctly based on, whatever the market environment you're trading. So that's a big part of it. The market environments are always changing, so you have to adapt to the environment with the correct option strategy. So I kind of call this the debilitating trading dysfunction, the option strategy confusion, or OSC. So, what you really need to know then to successfully trade options, no more OSC, options trading, strategy confusion. We're going to go through a few steps that hopefully will help you out. step one is then you need to understand how option pricing works. So this is going to really help you to maximize your option trading profits. Understanding the fundamentals of option pricing is going to be so important to that. So when we're trading options, the most important option factor are understanding the concept of time, and then volatility and the impact that they have on the price or the value of your option. Now, when we look at time value, that's what we call the extrinsic value of your options. It's a premium that a rational investor is going to be willing to pay over the current exercise value, which is your intrinsic value, based on that potential for it to increase in value before expiring. Now, the change in this value of your option based on time value can be measured using the Greek we call theta. So when we look at time decay, it's always going to work also against the buyers, and it's going to benefit the seller of options. And why that is because when we look at theta, it's got either a positive or a negative characteristic to it. So for example, if you're long a call option or if you're long a put option, that's going to have what we call a negative theta value. Okay, so that's going to indicate that is going to actually lose value as expiration draws near, unless it goes in your direction that you need it to, because the theta decay starts really impacting that option. Now, the other side of that is that if you're short that call or short that put, that's going to have a positive theta value. So that gives you, that value, you're actually gaining the value, as expiration draws near. So it really accelerates, and that premium, and it ends up going into your pocket. So these are the two things you really need to understand in order to, trade options and, how to correctly trade it and pick your different strategies to use. Now, many option trading strategies also will sell out of the money options on top of buying at the money options or in the money options in order to offset that negative theta. Okay, so this is going to result in a lower rate of time decay, and also it's going to lower your capital at risk. Now, these are kind of trades such as you might have a vertical bull call debit spread would be one, or a vertical bear put debit spread, or a butterfly spread, or the other one is the long condor spread. Now, when we look at the next big component of pricing is volatility. So implied volatility then is expressed as a percentage of your stock price. So it's basically indicating a 1 standard deviation move over the duration of your option cycle that you're using. Now, in theory, a stock should end up within that 1 standard deviation price range of its original price 68.2% of the time. So theoretically, now again, this is a theoretical, kind of statistical value point. But when we look at the probabilities, we can then forecast the security's price range, and we can do that by what we call the implied expected move. So this process then is also going to help us helping us to select the highest probability price target. So that's the first thing we're going to do is first, look how to back into, looking at your kind of a 1 standard deviation price forecast. So then we can determine certain profit target points we want to use for our trades. So then when it comes down to the value of our option, then it's really the time value component times the implied volatility times the underlying security value or the intrinsic value. Now, once we know these variables, then we're going to be ready and able to price out the option, and then also know what option strategy should be used based on the market condition. So this is a nice little table that will kind of show you the flow through of these variables and how they impact price. So here's time value, times the implied volatility of your underlying security times its intrinsic value. That's going to give you the value of your option. So, day one, now, most stocks now are going to have weekly options, okay? And some of the ETFs will have, daily options, et cetera. But when we look at these weekly options, for example, they're going to, come out the Thursday, okay? On Thursday, we're going to have a new weekly option series. Now, on that first day is going to have 100% time in the value, or that component of the option is going to be 100% time value. So now I just plugged in a number here of the implied volatility of 300 times the intrinsic value. I'm going to leave this at 1, constant of 1, so you can just see the flow through of time times the implied volatility, how that affects premium. All right, so in this example, the first day we have 100% time times the implied volatility of 300. So that gives us the value of the option of $300. Now, going into the weekend or even over holidays, we're still going to get that time decay. And when you come back in on a Monday after the weekend, you're going to see that the time component is cut in half. All right. So even if we've raised, or even if the value has implied volatility has spiked up in this example to 800, you can see the value of the option didn't go up very much because that time value component had been cut in half or decayed in half. All right, so that was only 400. Now, if you had the implied volatility of only 200, then you can see your option price would only be $100 in value. So these are things you need to understand. You need to understand the impact of time and volatility on the price of your option. And at the end of that option series, time goes to 0, okay, and the implied volatility go to 0. So it's a decaying part or kind of asset that you can see the time component decays to 0 and implied volatility of that option series. So you need to be aware of that, know how it works, and then kind of design and structure trades to take advantage of these two components. So you can take advantage of it by either getting cheaper options or selling volatility, things like that. So many really great things we can do once we understand the kind of the basics of options and kind of how they work, the value of them, so we can get an idea, what makes them tick. All right, so that's the thing to understand. Now, we can actually then trade time, and time, we can do that by selling time. So this is going to then take advantage of that option time decay or theta. So when we're selling an option, we are in essence selling time, and we're also selling volatility. The other really kind of great way to think of an option is kind of think of it as like a coupon that you might get at a store, grocery store, or whatever. But when you look at that coupon, you're going to look, you always look to see, okay, how long can I use it for? When it's going to be redeemed or when it's, going to expire. Well, that's exactly how an option is, because we have all these different option series, and at the end of their period, they all expire, and all those components that make up the value of the option will go to 0. All right, so that's another really kind of way to look at it. Now, the other thing is, this is a great example to kind of show you how time decay really tails off. So when we look out in time, let's say we go 120 to 90 days out, the time decay component is very, very small. It's very, very small. And you might have heard this saying that, if you're a buyer of the option, time is the gift of a buyer of option. So the further you go out, the less time decay impact on the value of your option. Now, as we get closer in, you can see that it starts to really tail off. This slopes down really fast. And when you're 30 days out from option expiration or day 0, that's when it really accelerates, okay? And we can really take advantage of it for even different types of options, selling strategies or buying strategies where we're getting cheaper options. But we also then have those, the weekly options, which really give us a great advantage for doing all kinds of additional structures and trade setups based on the weekly time acceleration that we get from that. All right, so that's a kind of a graph there. You can see how it really tails off and really starts to escalate as we get closer to time. Now, step 3 is to understand probabilities and what I call the market maker secret. It's what they really don't want you to know. So the market makers are kind of the professional option traders and the ones that are actually making the market. And so what they don't want you to know is how the option pricing components work. And what they're doing is collecting that premium from the buyer. Okay, so because of the mathematics behind it. Now, when we look at the option markets, the option market models use mathematical market probability statistics then for pricing the movement of an option to its expiration. And these option models are based on what we call the Black-Scholes model. Some of them have a little bit of different tweaks to them, but it's all based on pretty much the same. It's all based on the Black-Scholes, which is the time component, the implied volatility component. They put in an interest component, and then days to expiration where it's trading. Those are all plugged into the model, and that's going to give us, different various analytics that we can use. So one thing though the model does is going to help us, look at probabilities. And so by knowing the probability of an underlying security finishing within a certain price range at its expiration becomes key for determining what options to buy or sell, and then what option strategy to use. Now, this statistics forecasts and how likely it is that the option you're going to buy or sell will fall within a certain option price range series, either up or down by its expiration. And this forecast is what we refer to as the implied move of your stock or security, or the implied expected move. You might hear it called that. And all it is the estimation of about a plus or minus 1 standard deviation move of the underlying security based on its expiration period. Right, so this is kind of a really key step for any of your option trading. And the way it works, this really kind of helps you to understand the concept is when for example, if you're going to sell an out of the money option and you are selling it 1 standard deviation out of the money, basically, theoretically, you're going to start out with an 84% theoretical chance of winning, all right? Now, the way that works is, let's first look at this normal distribution curve, okay? So at the top of it here is your price at the money, so $500, okay? Now, the implied expected move, which we'll go into how that's calculated, in this example is for this, security to move up or down 4%. Based on the implied expected move, which we'll go through next. Now, and that then is based on how many days to expiration. So let's say it's 10 days to expiration. So over the next 10 days, theoretically, with an implied expected move of 4%, it could theoretically go up to $520, or it could go down to $480. So that's a 1 standard deviation price range, either up or down, and that's kind of the range right there, 1 standard deviation. Now, the way this works theoretically is that if you have that outside point that you sold here, right here, let's say 520, that's going to have what we call like a delta of about 16, plus 16. So I basically look at a delta of 16 or 20 as that outside kind of 1 standard deviation point. Now, for example, then if you sold that, a delta of 1 is equivalent to, the way it works is equivalent to 100 shares. Okay, so if you had a delta of 16, then you sold that, then the difference is 84. So what that is telling you theoretically is that if you sold that 520 strike, 10 days expiration with the implied volatility, at that point, 4% up or down, theoretically, there's an 84% probability that price will close below 520. Or the other side of the coin is that it would close above 480. All right, so that's based on that delta of 16. All right, so that's how that works. So remember, one option contract is equivalent to 100 shares. And then if you have that delta of 16, the balance is 84. So that's one way that you can look at it. Now, the other thing about delta is, if you have a delta of 16 or something like that, that's also like you're owning only 16 shares. Okay, so that's another way. There are a couple different ways that you can use delta, either, to kind of base it on how many shares you might own, or the probabilities. That's kind of the way that we'll use it. And we'll go through a little bit more of that here in a minute, but that kind of helps you kind of get a picture of that. Let me take a question here. What's going on when a buy or sell an option goes up or down by pennies, sometimes several times during the process? Well, that's because the markets are moving, right? So the price of your option is going to change based on the price, and also then there could be volatility changes during the day. That's going to impact the price. And then if you're holding it more than a day, then the time value is going to set in. But these option prices will change all during the day if the market's going up or down a lot, just based on that pricing. That's going to change that delta component of your option. So here's an example of option delta. So here's kind of an option series, and this is an example on Apple. And Apple in this example is trading at $190. So this option series here, the 5 July, has 28 days to expiration. So you look here at the money price here, the 190, you can see that the delta of that says it's a 0.52. So the way that you can look at that then is you've got, that's basically a delta of 50. So at the money, you're going to have basically your delta is 50. And so that says that you're going to have a 50% chance or probability that price will be at 190 or below, or 50% chance it's going to be at 190 or above. There's a 50% chance for it to be at 190, basically, okay? So that's that delta 50. All right, so, using that, then we can start, kind of forecasting. Now, as you go further out, like, look, for example, if you go to that 215 strike, you can see here the delta says 5, all right? Now, again, think about that, what I was showing you early. If you have a delta of 1, which is equivalent to 100 shares, and then you have that delta of 5 right there, you can see here, this is probability out of the money. Okay, it says 95. So the difference is 95, right? And so then theoretically, if you bought an option with the 215 strike, there's a probability that you're going to have that thing below 215 85% of the time. Or the other way to look at it, if you have that delta of 5, there's a 5% probability that price will be at 215. So you can see the big impact. If you were buying that option at 215, theoretically, you only have about a 5% probability or chance that price will be at 215 at expiration. But the other side of the coin is that if you sold at 215 strike short, there's a 95% probability that price will be below 215. All right, so you can see how that can really help you, look at probabilities and assess the probability of something happening really quick based on this kind of data. Yeah, sometimes a quote feels like I'm haggling with the market makers. Yeah, that can happen. Now, especially if you get in a security that doesn't have good liquidity. But when you're trading apples at Apple, this has great liquidity, so you can really get quick and tight deals. All right, so that's kind of a basic summary of Delta. There's more to it than that, but that gives you kind of an idea. Now, step 4 then really comes down to how do you select the perfect option strategy, either up, down, or sideways. Okay, so that's the market, which could be a specific stock, ETF, what it is, whatever you might be trading at that point in time. And then the next thing I do is I want to identify specific chart patterns. Okay. Now, in the course that we'll start next weekend, I'll go through in great detail these type of patterns. There are 5 specific patterns that I look for. All right, so this really helps me then to identify the type of option strategy to apply to this specific pattern. Okay, so that's another part of the step or the process. Then the other part, step 3, is you want to know what is your time horizon for your trade. So what's your trade duration? When do you expect it to make money? Are you looking for your trade to be kind of more intraday, make it today? Or are you going to be more, give the trade some time? You might think, well, it could be another day or two, maybe next week, next month, or we could even go out and have a very long-term trade horizon of a year, 2 years, or 3 years. So I'll show you kind of a strategy we use for that. So there are a lot of different, option strategies to use, and part of it comes down, what is your time horizon or duration? So that goes into the process. And then the next thing, a big part of it, is your capital that you're really, willing to put at risk. So this is going to also really be influenced and based on market condition. So, when we're in a low risk environment, we can do certain strategies that we're not as tight on the risk control versus medium term or high risk. Now, when we get an extreme high risk market environment, there's certain kind of go-to strategies we're going to use because they really limit the risk, but also can maintain a really good return on that risk. So we're going to go through a bunch of different examples to kind of show you an idea of the different variations that you can use and how you can use these for the various market conditions, okay? And then the next thing is, what is your objective for your trading? Are you looking for more income? Are you looking for, a profit-based trade, just for like swing trades or day trades? Or are you looking for more kind of trading where you're, going to have a bigger hedging component? And, are you looking for trades where you're really concerned about your tax situation, capital gains? So, these are things also to consider that are part of the process of picking the right strategy that you're going to use. All right, so that's part of it. Now, the next thing is what I call my go-to option strategies. And so these strategies are going to be used. I use it based on whatever the market cycle is at that point in time, the market conditions then also that we're trading in. So there are a lot of different strategies that we can use, but the ones that I've really liked to use over time are going to be just long calls or long puts. I love vertical debit spreads or maybe a vertical credit spread, butterfly spreads, long condor spread, calendar diagonal spreads, and then another one that's a great one in certain situations is the synthetic long option. We can do that for covered calls, which is a really great strategy for a longer term trending kind of market environment. So there's a lot of different ones that we can match up with the environment we're trading to, design it for the risk of the market, okay, and for the reward we're looking for. Now, in general, when we look at calls or puts, they can be used for your day trades or swing trades. So these can be trades. A swing trade could be a trade of a cycle, a daily cycle, which could be 1 to 10 days, basically. And we can use also longer term type of trend trades. So generally when you're buying calls or puts, you're going to be looking at like a delta of 50 or 70. So when we go deeper in the money, like a 70 delta, theoretically that says you've got a 70% probability of that call that you bought at that 70 delta or the put you bought of that being a winning trade, okay? So that's how you can kind of think of that. Or we could do vertical debit spreads, which is a really great strategy I like because we can use these for our swing trades or longer term trend trades. But the vertical debit spread, the great benefit of that is they're very defined risk. I mean, if you're long a call or put, they're also defined risk, but they could be more expensive, because of the time value and the implied volatility component. So we can make a vertical debit spread though, and we can still have, a directional play on a call using calls or puts to the upside, but we can reduce our risk and also reduce the time decay impact of it by doing it as a spread, a vertical spread. So this will help us, to do that, define risk. It lowers our capital at risk, and it's going to lower our time decay component. Now it's going to be capped for your profit, also capped for your risk. And then the other kind of component is what we call the vertical credit spread. So this is the kind of the opposite of the debit spread. So this can be used for your day trades as well or swing trades. So this is a spread strategy used for, when we get in a higher implied volatility, we can take advantage of this to collect that bigger premium from the volatility component. But it's also, since it's a spread, it's also defined risk, and that takes advantage of the time decay again and sideways price action of some kind of, a pattern that we're trading. So the vertical credit spread is great if you're in a kind of defined price range and you've got a better implied volatility component. We can do that and just, play the range, okay? So these are just kind of an outline. We'll go through a bunch of examples here next, but I just kind of wanted to go over the kind of the broad, kind of define what they are. Now, here's a look at a vertical debit spread, okay? So this would be like if you're, say here, for example, you're long a call, and this would be long that call at the 10-10 would be your strike right there, down right there, okay? So then you're long that call, and then to make it a debit spread to reduce the risk and time decay, we could sell a call above it out of the money. All right, so we sell this call, that 10-20 call here. All right, so we're long that call, that's a call debit spread. Now, the debit spread, then the spread width is what you're going to look at. So if you look at that, that's 10-10 on the buy side, 10-20 here. So what is it? That's a $10 wide spread. Now remember, one option contract's equivalent to 100 shares. So a $10 wide spread would actually be times 100 is $1,000 wide, $1,000 wide. Now, in this example, you can see it's a debit spread. So the debit then is the risk of this trade. So the debit cost on this spread is $300. Okay, the spread width is 1,000, so the cost is 300. The risk, the difference then is your potential profit at expiration if it closes above your short strike of your spread. So your potential profit here then is $700. Your risk is 300, so that's a pretty good return. So that's a 233% return. So in other words, you're going to risk $1 to make potentially $2.33. Okay, so this is what we call a positive risk ratio trade. So these are great little trade setups. Okay, these are a great way to play the market where you're defining your risk, you're lowering your time decay component, and you've got a good return on your capital at risk. Okay, so that's your vertical, debit spread kind of outline there. Now, the next one and the other side of it is the vertical credit spread. So this is kind of just the opposite of the debit spread. So in this example, you're selling short that 10-20 strike right here in this example, and then you're capping that short call so it's not naked short. Now, if you're shorting a call or shorting a put, that has unlimited risk. In this example, if you short a call, there's unlimited risk to the upside. Now, if you want to cap that risk, though, we can do that as a credit spread by just buying a call above it. So in this example, we sell short the call, but we at the same time are buying an upside call above it at 10.30. All right, again, $10 wide spread equals $1,000 wide. Now, for this spread, we're going to just bring in the credit received. So that's going to be your profit. That's your premium that you collect. So that's $200. So that's your premium. All right. So you get $200. That goes right into your bank account. But you can see the difference is the potential risk of this trade, which would be $800. So this is what we call a negative risk ratio trade. We're actually risking $4 to make $1. Okay. So we can make $20 or $200, excuse me, here, but our risk is 800. So, you're thinking to yourself, well, why in the hell would I ever do that? Well, the reason is these are, based on theoretical probabilities, okay, based on the option model. And again, we looked at those deltas and I showed you, like if you shorted that delta of 16, theoretically going into that trade, if you've got a delta of 100 and you shorted that outside 16 delta, was your short strike, let's say that was the 10-20 strike here, then that's theoretically giving you an 84% probability that price will be below 10-20 at expiration. So that's why you're not getting that huge, amount of profit, because the probabilities are so high that that'll be below your short strike. That's how it dictates that ratio. All right, so these are what we call a negative risk ratio trade. All right, now, but when you combine the two together, you can do all kinds of really cool stuff, and we'll go through and talk about that here in a bit. Now, the next one, though, is what we call the butterfly spread. Now, it's a very unique strategy that combines buying and selling the option. So it combines that vertical debit spread with a vertical credit spread. So you can go either way. You could have a vertical credit spread, match it with a debit spread, or debit spread, match it with a credit spread. So you can really do some fantastic stuff, with these verticals once you understand how they work. Now, this is going to then, the butterfly will also give you a very defined risk trade. All right, so it takes a really big advantage of that time decay and implied volatility, which both of those components go to 0 at expiration, so we can really take advantage of that. These butterfly spread will always give you a positive theta, no time decay, which I love. We use these for directional, non-directional swing trades, so it could be a trade for 1 day up to 2 weeks. Now, the sweet spot, you don't want to go too far out with the butterfly because it becomes what we call dead money, which we'll talk about, because of the time component, volatility component really don't start paying off until you get into that expiration, closer to expiration. That's a big part of it. Now, these are going to be great for, really high returns on your capital at risk. So of all the option spreads that are out there, all the different option spread strategies, the butterfly spread will give you the highest return on capital of any of these types of spreads. And so you can literally get returns of over 1,000%, even 2,000% sometimes by using a butterfly. And we'll go through and I'll show you some examples of some that have come close to that. And also just great for hedging when you understand how to mix and match. So if you think back on that prior, debit spread and credit spread, so here's the debit spread. You had that long the call, you had that short call right here, right? 10, you're long the 10-10 call, short the 10-20. Now, all we have to do, if we want to convert this to butterfly, we just sell that credit spread side of it. We sell the 10-20. So we're selling another 10-20 strike. We're capping that risk with the 10-30. We have now a balanced butterfly, which is, $10 on each side. So each side of the spread here is $1,000 wide. All right, so but now we've reduced our risk to just $100. Remember, we had the $1,000 wide spread. We had the butterfly. We had the original debit spread with $300 of risk. Okay, that was our debit. But by adding a credit spread, shorting that, we brought in $200. Okay, so now we've only have total risk of $100 on this spread. So basically, we've reduced our risk from 300 to 100. And if it goes out what we call the top of the tent right there at expiration, this has potential to make $900, and that would be on your risk of 100. That's a 900% return. So risking $1 to make $9. So that's the kind of cool stuff that you can do, with these type trades. So we could do this, as a spread all at once, or we could leg in, leg out, so a lot of flexibility that you gain. Now, the next one is what I kind of call the cousin to the butterfly. So this is one we use a lot. This is in this market, we're always looking at long condors to use, not to be confused with an iron condor. And we'll, go through the course. You'll understand at the end of it what the big difference is. But the long condor, like the butterfly, what it does is going to combine vertical spread. So it's going to combine a vertical debit spread with your vertical credit spread, but it does not share the same short strike of the vertical debit spread. So, when you have a butterfly, you've got to really, really, that's kind of like threading that needle. You've got to really be precise, right? But with the long condor, we can widen out that profit zone area. All right, so we're not short that same strike there. So that's the beauty of it. So we can widen it out, but we're going to get a bigger profit zone. Also, no time decay. All right, great for swing trades. 1 to 2 weeks out. Provides us a really good high return, very low capital at risk. Also great for hedging. So the butterfly and the long condor are two great hedging vehicles that we can use once you understand the verticals. Here, George, use this link here. Okay. Click on it or copy and paste it. And then to get the 15% off once you go in there, just use OP small cap, OP like option 15, put that in there and you'll get that, discount, okay? Send me an email or whatever, and we can get that to you. I don't have it right now. Just, if you don't mind, send me an email, okay? And I'll get that for you. All right, thank you so much. All right, so that's kind of the profile of what you're going to look at for the long condor. And again, we can design these trades to for an up cycle move or a down cycle move, depending on what we want to do. So if we're in a trending cycle up or trending cycle down, we can shape the long condor, with either using calls or puts. So that's basically the condor. So you can see the difference here. For example, if we're using calls, we're long a call, short a call, but instead of, having a really tight thread the needle there, we can widen out the profit zone. And we've got a great, beautiful spread here. which is going to lower our capital at risk and give us positive theta. All right, big, huge plus. So once you start trading options, you're going to understand how theta can impact your trades, right? So it's the beautiful trade of that. Now, the other one that is a great strategy to add to your toolbox, and we do a lot of these, as you're going to see, or calendar diagonals or calendars, okay? Now, these are really great for kind of a medium to longer term duration trades. So when we're looking for, we want a kind of a longer term duration, doesn't mean we can go out years on these trades. We could go out 1 or 2 years using leap options, but typically we might go out, maybe 2 or 3 weeks, maybe a month, 2 months, or something like that. So really great for medium to longer term type trend trades. So these are basically a directional option strategy where you're speculating on the trend, either for upside or downside, and these give you a great way to hedge as well. So basically what these two this kind of strategy is, just think of it as like a vertical debit spread, but instead of being in the same duration for both the long and the short leg, we're going to have a different trade duration. Okay, so what we're going to do is your long option leg is going to be set further out in time. Okay, so think about it. So if that's further out in time, it's going to be less time decay on that. All right, so the further out in time, remember, the less time decay. So the long leg is set further out in time, but we're going to sell the short leg closer in. So instead of doing a debit spread that's all in the same series or time series, we're going to be having the short leg closer in where it gets that accelerated theta decay, and that really helps to create discounting on the long options. So we're actually, buying options at a discount sometimes if we do this. So this will be a big chunk of the course as well. So this is a real favorite. So this is used then to take advantage of the short-term weakness that we get or strength that you think will eventually happen. So you want to trade bias to the upside or downside. So if you think it's going to eventually in time go up, but right now maybe it's churning, but eventually going to go up and cycle back up, we can use calls, or if we think it's going to cycle down, we use puts. But this is going to provide us a way to collect time while we're waiting for that direction to kick in, but also be positioned for that big directional trade. And while we're waiting, we're getting paid by the discount or the option decay, all right? So it's a beautiful strategy for that. So again, it takes advantage of that accelerated time decay characteristic of the front short dated option that decays at a faster rate, but you're long the back long dated option, which decays at a slower rate, all right? So we get that benefit, but it's a spread, a vertical component to it, or diagonal component to it, that gives us potential for a big profit. Now, by having that, when we do have what we call a positive volatility skew, this also gives us more benefit. We'll talk about that more in the course though. Now, the big thing that really makes these trades stand out that I love so much about it is there's that vertical spread component to the trade. And that's what really adds the directional element for really potentially great profits, okay? And again, I call this kind of buying at a discount. So let's say you do a calendar diagonal and you're looking for it to go up, but it's been a market that's churning, it's really consolidating, trying to hold, form a base, and then you eventually think it's going to go up, you're going to get paid. So what you're going to be doing, we're going to be our long leg's going to be further out in time, but the short leg's going to be closer in. So while it's churning here, waiting for this thing to take off, we're getting time value going into our pocket. Now, what we typically will do then, if we're long, let's say we're long, 30 days out. All right, so we're long that long leg 30 days out, and we're short the short leg maybe a weekly, so 6 days out or something like that. So what we can do is we take that, at the end of the week, at the end of that 6 days, or end of the week, we take that time and we roll it to the next week, the short strike the next week, and we're getting that time as long as it does go through a short strike. But it's a great trading strategy. We do a lot of these in our trading room with the alert service. So this is also part of the alert service that you would get. All right, so here's kind of the diagram. And again, I like to kind of visually think of a vertical debit spread. Okay, so we have a vertical debit spread like I showed you earlier. So we're long that, we can do this calls or puts, so we're long that call debit spread. This would be in the same option series. So let's say that's for, you know, the option series expiring next Friday or whatever, what is that, the 8th of August, something like that. All right, so the 8th of August. So what we're going to do here, though, we're going to go further out on our long leg. So maybe we're long this one, we could be long this one out in September, okay? But then we can be short the call against it 8 August, okay? So that gives us that accelerated theta decay of the short strike here versus having it in the same time duration, but also then it's going to reduce the cost of our long dated if we keep that premium. And then we've got longer into this trade. So you can see that if this is out to September, you know, we've got 3-4 weeks to work the trade. So it's just a beautiful strategy for the right conditions of the market. So that's what you want to do, is learn and pair these strategies to what you're trading in the market environment. Now, the next one, which is a really cool strategy as well, and for a longer term trend, is using what we call a synthetic long option strategy. So what this does is it's going to be set up and designed to replicate the exact payoff of owning the underlying asset or owning the underlying stock. All right, so it's what it does is by combining different option contracts to reduce the cost of the trade plus reduce your theta. And so then once you design this correctly, you're going to gain exposure to the price movement of your underlying stock while requiring a lower initial investment. So just, you know, think about it. If you're, you know, buying shares of a stock, you know, if you're buying shares, let's say that you've got, shares that are, you know, 200, what did I do here? Hold on. Let's say you're trading, you know, some stock that's $100, right? So to equate that to, you know, an option contract, you buy 100 shares, you know, that would be, you know, times, if you did that 100 shares, you know, let's say you had shares that are trading at $100. And so one option contract is equivalent to 100 shares. So let's say you bought then 100 shares of a stock that's $100. Okay, so that's going to cost you $10,000, right? You bought 100 shares. So that's equivalent to one option contract. Now, if you bought, you know, say $100 strike, you know, that might cost you, I mean, it could literally, depending on where, if you're close in duration, let's say you're further out, that could cost you $5. So that could, you know, $100 strike, that could cost you $5, right? Now we're going to do this, and I'll teach you in the course how to do this, where you're going to be actually controlling this stock that's maybe $100, which would cost you $10,000 for 100 shares. How you're going to do it for $500, and you're not going to lose time with this trade, and we can go out and structure it as far out as we want. We can go out 1 year, 2 years, we can go out 1 or 2 months. And then the beauty of this is we can also design it where we can buy a put below it to have it as a covered put to protect our downside. And we could then sell a call above it to play it for a covered call to take advantage of that time decay on the call, and then just adjust it, you know, and we can eventually amortize this down to zero or credit. So these are just an unbelievable trade strategy for a longer trending market. So then it converts to a great strategy for covered calls because we're replacing expensive shares with the synthetic long option, which does exactly, kind of mirrors the shares, but at a fraction of the cost. So just think of the potential that you get from this. So here's like the stock goes up, the synthetic long is going to go up exactly like the stock. There might be a little bit of difference because of the slippage when you design the trade. Now, you know, as it goes up, you make money. It could go down though, and you lose. But so what we can do is we'll buy a put below it, So we'll have it covered with a put, and then if we want to start selling calls against it, we've got a fantastic strategy for a covered call with a protective put. Just a beautiful way to trade. So now let's go through step 5, and we'll go through a bunch of different examples so you can get a really good idea of what you're looking at, what the potential is. So we're going to look at the vertical debit spread. Now these are the ones that I really typically go to, okay? So we do, a lot of we do really a lot of long condors, a lot of calendars, okay? And then for very more selected specific setups, we'll do butterflies, and then the synthetic long is for, kind of a longer term type trade. And then the vertical debit spread is good for, certain kind of shorter term trades too, just depending on the market condition, okay? So a lot of times if the markets are moving fast, quick moves up or down, this is where the vertical debit spread pays off really great because there's less time decay. Yeah, you don't want to do a vertical debit spread typically way out in time because you do have that time decay component. So if we're going further out in time, we're typically going to be doing the long condor or the butterfly where we get, no time decay, we have positive theta. And also we can get very defined risk. These are all option spreads, okay? So let's go through a bunch of examples here to give you an idea. So the first one, we'll look at just a put debit spread. So this is on SPY, great for SPY, index option, whatever. And so this is a directional trade, structured for defined risk, great for hedging, used for kind of swing trade, medium-term trades, could be, 1 week to a month out. Going to lower your theta. You're not going to get positive theta, but you're going to get less theta decay than if you're just long, say, a put. You'll get a typical return of 1.5 to 3. What I typically look for on these is kind of a minimum when setting up the trade. It doesn't mean you're going to always get it. I look for a minimum of getting $1.50, on making $1.50 on $1 risk. Okay, so basically risking 100 to make 150. Okay, so that's kind of my minimum, and then you typically can do 1.5 to maybe 3x time return on your capital. So you risk $1, you could potentially make $3, but I look going in to make risking $1 to make at least $1.50. All right, and then we can do other cool things to it to enhance and increase our return. All right, so that's your typical thing. Now, these are all alert trade setups, and so are trades that we did in the trade room that I've done. Now, this is one that we did on SPY. It was a short trade, like on the 6th of September. So at that time, it was trading at $549. Okay, so it was a short trade. All right, you'll see then we took profit the same day. Look, this was kind of like intraday trade. It's moved so fast. So when you're shorting a market, you can get these accelerated moves. So it's a good way a strategy to use for a really hard looking potential down trade type market. So here it was, just to kind of outline it, was trading at 549. Here it says new SPY retracement short. Okay, so 549. So buy that vertical debit spread. So it's buying this 548, 543 put debit spread at around $1.35. So that's going to be risking around $135. Okay. So then the market moved down hard to 539. So let's take a look. So these are, like right now, in this market, where if we're going to get a sell-up, this is a good trade strategy to use for a really quick move down, kind of momentum-based kind of trade strategy. I like to use it for. So you can see here, it was trading at 549 right here. And see, that's the 50 simple moving average. Look at that support. It was looking to break that. So the potential for a big, fast move down when you get these types of breaks, right? So that's what you're looking for is what I call open prairie, where you break a key major support and then you have a very quick move to the downside. So that's what this was set up for. So is that 549, took profit right there in a really quick in and out type of trade based on that momentum and the market falling hard. So here's the trade setup, the profile, what it looked like. So it was trading at 549. So here's the 10 September series. So this bought the 548 put, was selling the 543 below it. So you had a cap trade. Spread width then is $5. So 548 less 543, that's $5. So $5 or $500. The cost of the trade, the debit cost was $1.30 or $130. All right, so you've got your cost of your trade there. So the potential profit, if it closes below your 543, you make $370. That's a 284% return. So risking $1 to make $2.84. So you can see here your potential profit, your cost here, and that's what that looks like, your debit spread on that. All right, so that's a really great trade setup for a really quick moving market, either up or down, but really down, these things can perform really fast for you. So here's the profile, here's your long nut put, at the 548 right there, and then shorted that put there, to reduce the risk of this trade and also give yourself a little bit more positive data. So here's the trade there, and boom, here's where it went out. Now, your max profit is going to be at expiration, but when we're shorting the market or whatever, if it hits our profit target, we'll just go ahead and take profit. So it was actually right there. So this went from, the spread was at $1.30 right here, and the spread then blew out to $361. So at that point in time, this was up $231 on your risk of 177% return in one day. Okay, so really quick, fast, momentum type based trade is kind of the way that I like these. Now, like we had exactly on Friday, we had that. If you've been ready for it, you can just see here. I'll just show you a quick kind of view of kind of what these are really designed for. Just pull up, and I had one that I was going to send out, and it just fell so fast, I missed the trade. Okay, so we'll see where we are on Monday. But here it is. Okay, here this is the perfect example for a debit spread, and this would have been a put debit spread. You can see this big support area here, right here. See that area through there? Now, when that breaks with momentum, see that big support area through there? Now, when that breaks, there's potential for a really fast move down, and that's perfect for the debit spread. So for example, that put debit spread. So I was looking at that. All right, so that's kind of the chart pattern thing to be looking for, just kind of quick outline of of how that can work. All right, so that's that trade. Now the next one is your wide wing butterfly. Okay, this is a really cool strategy. It's going to provide you bigger profit zones. So you're going to make it really wide, real wide net, right? And this is going to be great for when we're trading really high volatility markets or high price stocks, because we really can reduce the cost of the trade. It's going to be defined risk, great for hedging, great for targeting trades. We set up our targets. These can be great for target trade for what we call pinning. Great for high volatility markets because we can really keep our risk down. When we're higher implied volatility, we're bringing more premium for the butterfly. We're going to reduce that cost that way. Trade duration, these can be set up for a one-day trade, or we could go 1 to 2 weeks out. You don't want to go too much further out because the way that they design as far as time and volatility component will always gives you a positive data, no time decay. Returns of 2 to 1 to 10 to 1 or higher. These are just incredible trade strategy when you get that direction right and hit your target. So here's an example of a short trade using QQQ and doing this with a wide wing put butterfly, $10 wide spread width or $1,000 wide. So here was the trade setup. It was going to, again, a very fast move down in this trade. So it was trading right here on the 23rd at 314.60, right there. See that support, just like what I just showed you here. And so then it broke that support. And then we had a target for the butterfly down in this area here. See this next area? So right there. So we targeted this area here. So it's a targeted butterfly, but very short in duration because we were looking for this thing to move pretty fast. All right, so here's kind of the profile of the trade when it was set up to see what it looks like. So it was trading here at 314.60. We were looking for that target down there based on, that price action, Fibonacci, some other things we look at. Now, if you'd done the ETF and you hit that target, you're up 1060 a share or 3.36% return, right? So here's the butterfly though. We were targeting that 304. So we did the 314, 304, 304, 394, wide wing butterfly, $10 between the different strikes, okay? So $1,000 wide spread. The cost of the trade was $2.10 or $210. So the potential profit on this is $790 at the top of the tent, and that would be a 376% return, risking $1 to make 376. Okay, so that's just your profile, so you can see what you want to always know, what is my reward to my risk. Okay, first thing I always look at. So here it was going out, profit taken here. So now it was on the 26th, so set up on the 23rd. On the 26th now it was trading at 306.17. So it dropped down pretty hard to there. It was trading, it didn't quite get all the way to our target right there, but right there, because this is a wide wing, so we can really have a wider profit zone. So we don't have to get exact. If we did, that's great, but a lot of times you're not. But that's still a great return, making $572 per spread. That's one spread on that risk of $210. So the spread blew out to that 702. You can see right here, 782, $10 wide or $10 cost. So that gives us a return of $572 per spread or a 272% return. So we're taking advantage of that accelerated time decay, volatility collapse, low defined risk, high return type trade setup for the right situation. So that's your butterfly. Question, how do you establish targets? That's a great question. So do that with what I call price target mapping, okay? So that's a combination of what I'll do, whenever we put on a trade, before we ever execute the trade, we'll go through that as part of the step. So part of it is we want to look, what is our implied expected move based on the option series? That's going to tell us theoretically what the option model says that the price could go to. And then what I look for is what I call price target mapping. I'll look for a combination of things that align together, like are there moving averages that are big support area or resistance area? Is there a lot of price action? And so we can look at that, with the charts. And then I like to look at option activity, and we can do that. There are a number of different things that we can do there, which I'll teach you in the course as well. Okay. Question, if the trade starts to not go as planned, how do you get out? Yeah, so what we'll do is I'll do two different things. I'll look a percentage of your debit paid, okay? So if you've got your cost of $200, you could use a percentage stop loss level of that cost, so you don't lose the full 210. It could be 40, 50, 60%, something like that. It could vary as a percentage of that. Most of the time though, what I like to do is use whatever occurs first. So we'll use for maybe a stop loss if it hits and breaks and maybe closes below a certain support resistance area. So this was a short trade. So let's say it ripped back up and it was going back above a certain resistance area. That could be a stop. So they're a combination of things, and we'll go through that in more detail in the course, okay? But that's a great question. Now the next one, this is so cool because this is another butterfly, but this is one we specifically designed for what we call a pinning trade, where we think at expiration, we think the option will expire on that series. So this is one that we set up on Tesla, and this was a butterfly pin. And so our spread width on this was $250 wide spread. So here's the outline of the trade when we sent this out. So this was on the 8th of February. Tesla was trading at 189.35, and we were looking for Tesla based on option activity, Fibonacci, price target mapping that I just discussed. We were looking for a target to $200, on the day of its expiration, the 16th, okay? So set this up on the 8th, targeting out to the 16th, the 200 strike. And so this actually went to that strike and it made 231 spread. This was up over 1,925% return in 8 days. So these are possible with the butterfly, and this is why. So here was the trade. This is what we call a binary long or short. Okay, so either you win or you lose, but because the risk is so small, it's also what we call a lotto trade. So here it was trading it, sent out this alert, do a butterfly. It was trading 189.35, set up for potential monthly expiration pin at 200. So buy the butterfly right here, buy the 197, 200, 202 and a half at around $12. So that's your total risk, debit paid. Now then here's where it's going out on the 16th. So at that point earlier in the day, this was towards the close. It was now trading up to $215 per spread. The cost was 12, right? So at that point in time, this is up 1,791% return. Here it was going out at expiration right at the end of the day. It was at 200, right at our target. This was up 1,000, over 1,900% return. All right, so that's literally what you can do in the right situation with the butterfly. So here it was set up 189.50, 35, and then we were targeting 200 there. Here's the risk profile of what the trade looked like, setting it up. So long the 197.5 call, short the 200, short the 200, long the 202 and a half. $2.50 wide spread, okay, between the series, okay. So $250 wide, the cost of the trade, 12 cents, 12 bucks, potential profit 238, 1,983% return. Now remember what we're doing though, we're taking profit, but at the end of the day, we'll save some if we can, and for that potential pin. All right, so this one pinned exactly to the penny, which is just amazing. So it went out exactly right there at 200. So, from 189.35 on the 8th and on the end of the day on the 16th, right at 200. So it went from 12 bucks to max profit of 250 on that spread, which is a $238 per spread, 1,983. Now, again, you do multiple legs and then you have, 1 or 2 or 10, whatever contracts, and you're scaling out. But the whole thing is you're trying to hold a little bit right towards that end to really boost that return. But this was one that was really amazing, really cool. Now here is a good example of SPY doing a put condor. So this is a short trade setup, but with what we call the condor. All right, so this is going to be one to show you how you can do this for an adjustment to really get a great adjusted trade. So this is one this is a condor that we legged into. So on the 10th of March, SPY was trading at 568. So what we did on the 10th, we set this up initially as a put debit spread. So it says right here, new SPY short by the 563, 560 put. That would be a debit spread at around 85 cents or $85. Now, then on the 11th, though, it was starting to go down. So now it's trading at 555. So what we did to really enhance the trade, we adjusted this to a put condor right here by selling a bull put credit spread against it when it was down here lower. And we brought in a big premium to offset the debit cost. Okay, so we sold the 550, 547 bull put credit spread, and that converted this to the long put condor. And then, here it is on the 11th going out. Now it's trading at 558.85. This trade now is up at $205 a spread. That's a 476% return. And then going out, it was trading at 558. Now it was up $257, a 597% return a day later, doing this type of adjustment into the trade. So here it was set up here, broke down hard again, adjusted, and then took profit actually the same day later in the day. So here's the spread. Originally had the spread going in the 563. This was adjusted into the condor, and then sold against it the 550, 557. So we had the put debit spread here starting out. Then we added the short leg here to it, had a profit zone there. We reduced our risk here to 43 bucks, 43 cents, $43 on the spread width here of $3 wide on both sides. So $300 less our costs, $257 if it goes out between our spreads. So that'd be a 597% return. This is kind of exactly where it went out. This one went out right there. And so for max profit on this. So it went from 43 bucks up to 300. The spread blew to 300. So this is up $257, 597% return. All right, so that's one that we adjusted into, or we just a lot of times we just put them on as a condor. Now here's an example of a call calendar diagonal that we set up on. This was on CCJ. Okay, so this was a directional long trade setup, doing it with a calendar, which is also a defined risk trade. And this also takes advantage of selling time and volatility. We use this for directional target trades as well. And this is great because we can produce income. So we're getting paid while we're waiting for the trend to kick in if we need that aspect or part of the trade to work for us. Trade duration on this could be 1 week out to months. I mean, you can go out, you can actually go out and use leaps, right? Great trading flexibility. We do a lot of adjustments with this trade, always a positive data, no time decay. So here, I'm not going to go through in great detail here but this is the trade alert sent out. And so it said new CCJ long, it was at that time trading at 53 bucks. Question, do you hold out for max profit or leg out? Is there a case for holding to max profit? Yeah, so on the butterfly, I guess you're talking, on the butterfly, wait, do we, if you do, you want to do multiple contracts on the butterfly, and then you're going to be taking some profit. You want to try to be able to hold some right into expiration if you can, okay? So it's kind of, you've got to really kind of finesse it, but a lot of times you're not going to get it exact. So you want to take some profit and then hold some to see if you can get that home run, which will, obviously over the overall trade will boost your return quite a bit. Okay. Yeah, so question, based on the low price, would you buy 20 or 30? You could. I mean, literally done thousands, when I was brokering options for crude, we literally did, I think it was a butterfly trade for a hedge fund, that 2,500 contracts on a butterfly on oil. So you can do one, you can do 10 or 20, just depends on your, your risk profile, your capital count, Now this is one that we did on CCJ, 53 bucks, okay, it was trading at, so we did this and did the setup. Here it was, I'll just go through it kind of quick. So this was then buying a diagonal. It says it's called a diagonal, actually calendar diagonal. And here it was buying the 25-20, the 7 Feb, and then selling against it the 24 Jan, if you can see that. All right, so this was originally done at $1.95. And then we did on the 22nd, we did, it was trading at 54.80. We did a adjustment there. I won't go through it. We did adjustment there, and then now it's trading at 57.45. It was going up, and then on the 24th here it was trading now at 58. So we had done a couple of different adjustments on this to adjust the trade to make potentially the spreads. We adjusted the spreads, changed the spread, the different spread legs, and also that increased our theta. So a couple of different things here. Just I'll go through this in more detail in the course, but I'm just trying to outline it here today for you. And then we were hitting our 58 was kind of our profit area, and now the spread after the adjustment was up to $282, a spread, 151% return. So these are great when we want to we think something could churn and not take off really fast. So it's not a momentum-based trade. It's one for a longer term, a little bit more of a trending trade type of structure. And so that was the reason to use this. So this was what it looked like, kind of trying to walk you through it. So it was trading right here at 53 when we set it up right here. Okay, so we were getting this, see this base, it was starting to kind of form that base. So this is a trade setup that we use a lot of times for when the markets are just trying to base. So we can set the trade up and we're collecting income while it turns sideways and then boom, it takes off, right? So we set that up on the 21st, it was trading at 53. And then we did an adjustment to make it, adjusted the strikes a little bit to make it better on the 22nd. And then it was trading at 57. And then we took some profit, good profit on the 24th. It was trading at 58. All right, so here's kind of the first structure. When we first set this up, we had long the 53 call, the 7th February. That was long further out in time, see that? But we were short the 24 Jan, the 55, okay? So like a call debit spread, but we had two different durations. We had the long duration was the 7th Feb, and the short duration was the January 24th, all right? So we were long the 53 and then short the 55, and at that point in time on the 22nd, we took some profit. Now it's trading there, and so we had the spread went from 195, the original spread cost, to 253. So this was up $58 or 30% return. But we did an adjustment then on that day as well. So what we'll typically do, we'll I'll send out an alert, say, okay, take some profit if you have some to take, if you have multiple legs, and then let's adjust the balance. So that's what we did here, and then adjusted it to widen out the spread to give us a potential for a bigger profit. Okay, so we widened the spread out, and so now we had this adjusted trade. So now we rolled the long leg up to 54 from 53. And we closed out the short strike that was down at 55, I believe, and made the short strike at 58. So we widened the spread, see that? So we're still on the 7th Feb, short the 24 Jan, but we widened the spread out and we made a little money on the roll on the adjustment. So we had adjusted down our cost now to $1.86. And now the spread though was at 483. Okay, so now the spread was at 483. We had the adjusted price at $1.86. So now, based on our adjustment that we did, we're up $297, 159% return. All right, so big positive data there as well, 38 bucks. But anyway, so these are trades, we do a lot of these trades. All right, now this is the next one. This is pretty cool. This is synthetic long with the protective put. And this was one on Google that we had set up. Now, what this will do, it'll give you really a smaller upfront cost, a fraction of the cost of buying shares. Great for traders with limited capital. Allows an investor though also to free up capital for other investments. You're not going to have to buy the shares, so it's going to cost you a lot less than your capital, right? Built-in leverage, control large positions with less capital. Used for trading medium to very long-term trends on a security. Your protection, your downside protection, if you do it with a put or you do it without. Great for trading covered calls because we get we just have a basis of so cheap that the returns are insane. Trade duration can be 1 week, 2 weeks to 2 years. We can go out leaps. Great for hedging, always positive theta, no time decay. So here's a good example of what it looks like. So this is one on Google. Now this was then on the 15th of March 2024. Google is trading at 141.18. And then this was just timestamp. This was back then on July the 25th. This year, it was trading at 193.18. So I just kind of showed you from this time frame when we took this snapshot here. All right, so it went from here, 140, you can see it was all over 141.18, came all the way up here, pulled all the way back down, came all the way back. So just cycling, came back down here. But during this whole cycle period, so what you can do is, this is the shares, but what you can do is you're selling calls all along. like a covered call, right? So you're going to be able to adjust down and amortize down your costs. So here's just to give you an example of the difference. All right, so here's Google with the protective put. So here's Google, the stock, with the protective put. All right, so it was trading at 141.18, and then on the 26th of January, it was trading at 193.15. Okay, now here's the trade structure. So here is the cost of this trade with the put added to it is $148.80 right here. See, this is the hold on a second. Yeah, this is the stock. See the stock I was looking, yeah, so right here. See, this is long the stock, 100 shares, and long one put against it to make this a protective put below it. So long 100 shares, and it was trading when the shares, it was at trade at 141.18, but added the put. So that made the cost of this trade $148.80 per 100 shares, okay? All right, so that's where it was with the put. Now, on the 26th of January, when it was trading at 193.15, now the share value, now this had blown out to 194.16, okay? So it went from 148.80 to 194.16. So this with the protective put was up $45.36 per share, or on 100 shares, 4,536. So this is a return of 30.48%, okay? Because the original trade, it was trading at, was bought at 141.18, so at 14,880, okay? So see that? So the return here based on that move up was 30.48%. Now here's the difference with the option, synthetic option with added the put to it. All right, so look at the huge difference here. This is what's so exciting about this kind of trade. So now at the 15th, it was again trading 141.18, but instead of buying the shares, did this with the synthetic long with that put covered added to it for downside protection. So this was now trading at 193.15. So this spread right here, if you can see it, the cost back here when we set this up, it was trading 141.18. That spread with the put was a cost of $21.18. Okay. All right. So that is, if you look at that $21.18, you can see that times 100 is, what is that? Just $2,108. Okay. So huge difference, $2,108 with the put versus buying the shares. So here you go. So now this thing went from 21.18, and then on the 26th it was trading 193.15. So now that spread was at 59.18. So it was up $38 per spread, one contract. That would be $3,800. Okay. So you got to multiply it by 100, to make it into the value there. So 3,800 was the profit at that point in time. So you've got 3,800. Your cost, your basis cost is $2,188, $2,118 right here. Let me erase this so you can see it down here. There's your debit cost. And so that's a return of 179% versus if you did this with the stock with the put of 30.48%. So almost 6 times, 6 to 1, okay, difference. And so this is what the profile looks like. So here's the stock going up. Here's the synthetic right there. So it looks exactly identical. Now the difference is because you're long the put in here, so that makes that difference. You can see that. But as it goes up, you're making money. If it goes down, though, you're losing money. But you have that protective put below it to defend your downside. Okay. So, and then the other thing you do to it is you sell calls against it. So that's just a great, and the margin is going to vary. The margin is going to be, you're going to have a margin account or cash covered on the put side, but I'll show you in the course how to do that as well. We a couple different ways we can do that. Okay. But it's a great strategy, longer term, and just a fraction of the cost. Okay. So, today was just kind of a start. As you know, options are, my favorite trading vehicle for any and all markets and market conditions. But I just kind of wanted to go through and scratch the surface to show you all the different great things you can do with the different variations of spreads. Okay. So this was just kind of a taste. And then next week, we're going to get into it in greater detail. So if you'd like to join us, make sure to sign up here today. Use that link I gave you. Basically it's powercycletrading.com/special. Put that in, click on it, or hit it to your browser. Use OP15, and you'll get that discount of 15% off. Now this course is live but recorded. Will be broken down in modules of 30 minutes or less, like a chapter of a book, and it's yours forever. So you're going to get everything here starting next week, the 9th. We'll also continue on the Monday, the 11th, and Tuesday, 4 p.m. to 5 p.m. And then we'll do a dedicated Q&A the next day on Wednesday. So you'll have a lot of time to ask questions and all the different things that you may, come to mind that you want to ask about. So got a lot of good additional bonuses that come with the course, because these are going to help you actually with the course with these different types of spreads. So you're going to get the 4+ hour course. Now it's 4 hours, but it will end up being, with all the stuff I'll go over, 5, maybe even 6 hours, depends on questions. Okay, so you get all that value there, $1,600 for my time. So this will go out this week. It'll be $197, okay, to my clients if you don't sign up today. And if you sign up today, you'll get it for $167, package 1. You get all the stuff with it. You get my cycle reversal indicator. We're going to use this in the course. You'll get my extreme range band indicator. Here's what those look like. And you've got those for Thinkorswim, TradeStation. And so you're going to get, basically, this is just a quick example. You're going to get my cycle reversal indicator down here. It's a really great indicator. Let me lower this down here a little bit. So you can see here, see the cycle reversal right there, boom. You'll get this indicator. You're going to get also my extreme range band indicator. So these are, based on the movement from the 20-period moving average. These are ranges based on ATR. So these, when the markets get super stretched, this is a really good indicator to show you that. We'll go through how that's used in the course. You can see here. So this is on a daily time frame. You can see we got up here to that 3 ATR. See the cycle reversal there, and it started to pull back. All right, so you get that, those two indicators. Those are just going to be added to your cart at no extra cost, and we'll use those, with the course, with the different trade strategies. Then you're going to get my option masters course. Now this is more about the Greeks, so you're going to get that really extensive course, more in tune with the Greeks than we're going to go over the Greeks in the course this Saturday, but not as much as in this course, okay? And then you're going to get that 30-day trial membership. You can start it whenever you want. So if you want to wait until after the course, it's fine, or whenever. That's a $97 per month. Once you continue, we have other packages, but that's the base package there. We'll do that follow-up Q&A. You're going to get my option trading tutorial. This is an option guide, about 60 page option guide with the videos about the Greeks, delta, gamma, theta, things like that. And then I'm going to give you my kind of 15 other option strategy kind of manifesto, back ratio, spreads, things like that. So the full live course will be recorded, broken down in modules of 30 minutes or less. You'll get all of that. It's yours forever. So full, over $1,300 when I go out this week, $197 today, $167. And then if you want to add my alert service to this is course package 2. So you'll get everything in package 1, but you'll get my 5 different trading alerts that I send out. You'll get those for the next 4 months, plus my trading club, which gives you access to the trading room and some other things I'll show you for the next 4 months, and then membership to my trading club, right? Everything in package one. So this will be, typically I'll send out alerts for butterflies or condors based on the market, what's trading, what setups would be the best, or calendar, maybe a counter diagonal, monthly butterfly or pinning trades based on the butterfly, or even a calendar pin. We do those sometimes. Breakout reversal trades could be the debit spreads or credit spreads, and selective earnings trade setups. Okay, so these are the 5 different types of trades that I would send out that you might get. So then you can do them or not do them, just based on your process as well. But these will give you the trade ideas. A lot of people just want the trades and then they do their own thing. But when I send it out, I will always give you a selective, I'll give you an option trade to use. I'll give you all the, the duration of the trade, the different, what option series to use. I'm constantly updating the trades throughout the day, keeping you posted on them, on any adjustments, okay? So typically 8 to 12 stocks or ETFs a month. So these are the ones that I just went through, 5 different types that I might send out. Could send one, could send more during the day, just, depends. So I'll give you a trading guide for each one, what the option strategy is to use. I do a trade setup video at the end of the day to tell you kind of more why I did the trade, what I'm looking for on that trade. The trades are listed and archived. Then you're going to get access with the trading club to my weekly Q&As. These are live and recorded, so once a week for the next 4 months. My video newsletter every day after the close. My virtual trading room, so you can come into that every day during the day, 9:30 Eastern to 10:30, the first hour of the day, and sometimes go over. But if you have a trade that you need help on or see what we're doing, and then you're going to get, we changed this, it used to be 60, now you'll get a 50% discount on anything on my website, courses, software, whatever it is. So that's everything you're going to get, with the alert service. And then just kind of go through the summary of what we've done. I'll show you some other trades that we just have done recently. So here's a summary back when I started it. The first part of it was in May of 2018. Man, it's been going for a while here. Anyway, we've had 910 trades closed out, 564 winners, 65 break even, 191 losers. Try to keep a high winning rate. Okay, and also I'm really conscious about risk, try to really define and keep risk low on all these trades. So running a 79% winning rate, trying to hold it around 80 is what I try for. And these are unaudited, but just kind of a summary of those results, okay? So that's what you're gonna get there. And again, we'll go through a little bit more detail on some of the trades, but again, use that special link there. Here it is one more time. And then use that OP15 and you're set to go. And what you'll get, everything will be sent to you. You'll get your login information, all that good stuff from our customer service. Rachel, she does a fantastic job. Yeah, if you do if you add the indicators, you're going to get my 5 study set trading indicators. So what you're going to get here, if you do want to add the indicators, you'll get my volatility squeeze. See the dots here, you'll get that indicator. Comes with the support resistance package, and it comes with the lower studies, cycle 1, 2, and 3, these lower studies, okay? And so this will be good for Thinkorswim, TradeStation, TradingView, eSignal, Ninja Trader. All right, so that's all that stuff there. Now, if you've already got any of my indicators, I mean, I can't change and do anything additionally, change one out for another. This is just what comes with the package. And so these are just free additional bonuses to you, just to help your trading, to help you with this course. That's why I put them in there. All right, so then go to that. Now, here again, go to one more time. Yeah, let me go through it with you real quick here. The link here. So if you want to get it, so come over here, click on that link, and then if you want the indicators added to it when you come down to check out, whichever package, you can go right here, boom, click there, come down here. This is a super cheap value there. Add my directional trading indicators to your cart, and then put in the promo code. And boom, you've got everything. You've got the course, indicators, all that. You can do that with course package 1. If you do want to add the alert service, come down, do the same thing here, add the indicators, and there's a 2 pay for you as well, and then add your promo code, and it's a great deal. There you go. So appreciate the asking about that. Okay. Now here's a little great feedback. This was from Dennis, and that's how you get it to your cart. Did you see that? You just add it to the cart. You need any more help on that? It'll show you here. Okay, so if you buy there, here it is. I've got to go back out. Let me see. I can start over. Let's see if it refreshed. Here it is. Darn it. I think I'm gonna have to get a new link. If you have any trouble, let me know. It should just be right there. It was there, but it's since I already put it in, it's kind of stuck on it. Let me see if this works better. Let's see if it's refreshed here. Yeah, here it is. So if you want to add those, just come down and right there, you can see right here, add to cart, add to order. And there's then you can use, if you want, PayPal or credit card, and there PayPal has some really good extended payment type things if you want that as well. Here's a little feedback from Dennis. Said, just finished the master's course, loved it. Hedging on demand is a game changer and allows one to enter trades with confidence. Already 2 of my probability trades, which were hedged to make short strikes, were converted to butterflies, which I exited at a higher profit than the original trade forecasted. That's the goal on those. Slept much better. Reduces your stress, and the funds were reinvested compound interest, so a little magic seldom mentioned with options. And so we're going to start off here, just kind of an outline of what we're going to cover. There's a lot, but we'll first go through, understanding how options work. So we're going to go through the Greeks, the importance to these types of option strategies. Okay, so you're familiar with that. How option pricing works. So want to make sure you understand that for helping you to select the best strategies based on the option pricing values. The market maker secret, how to use it, how to use that standard deviation, take advantage of that. Really going to be important to understand standard deviation for our probability analysis, so we'll spend some good time on that. And so I'll go through this, what I say in layman terms, making it easy for you to understand how to use standard deviation. And also it's important that you understand option delta and how that's used for our trade probability forecast. So we'll go through all of that as kind of part 1, and then we'll get into how, why, and when to use the different spreads, but we're going to go through volatility skew as well. So these are really important things for you to know for these strategies or for just your option trading in general. And then step 2, we're going to go through the option strategy guide, which option strategy to use and when. So we're going to go through the kind of selection process for these are swing trade based. So we're going to go through how I set up, looking for the market cycle up, down, or sideways, how that's done. And that's where we're going to be using the indicators. We're going to go through my 5 chart patterns, what those are, what I look for, how we match those patterns up with the correct option strategy. So we'll do that. Yeah, we do have a scanner. Yeah, if you want to, good question there. Let me show you. And then I go through what is the market condition. So we're going to we're going to quantify the market uncertainty as high, low, or extreme. That's very important. And that's going to tell us the option strategy to use and time duration. Okay. So that's kind of step 2. And then here, yeah, if you want anything, now if you do sign up here today and you become a member, which you'll become a member, then the other thing you can do is just go to my website, powercycletrading.com. Let me show you this and we'll finish up. And if you want any of my software, just come here, click trading software, and you can come down here. Here's my volatility breakout scanner that's available to you. And so that'll tell you what it does, what platforms, Thinkorswim, TradeStation, eSignal. Come down here, more detail, and you can buy it. It's $397. Now, if you want it, add to cart, put in your members code here, and you'll get 50% off. Okay, so that'll be great savings to you. Or you might want my custom directional indicators. Now, if you do the 5 alert, if you do the 195 today, you're going to get these indicators for 195. Okay, so that's what you're going to be getting here. And so that tells you that. And then my multi-time frame, this is a great indicator. Just all my different indicators that I've designed are down here for you. And then here's the 2 that you're getting as a bonus. You're getting my cycle reversal indicator and my extreme range band. So those are 2 that are added to it today for a bonus. Now, if you're a member, if you just don't want the course and stuff today, you could add this to the course, get it 50% off. Okay, so that's everything there. Or if you want other courses, you can come over here to courses, trading courses, and go through everything I've got here. Okay, so that's just to highlight that. Now, so that's step 2. We want to qualify the trade before we put it on. So that's going to go be a big part of the course. And then step 3 is we're going to go through the process to select what strategy to use when. So what's the best selling strategy? What is the best option for buying strategy? What they are, how to use them. We're going to go really through that option butterfly, such an amazing trade strategy to take advantage of really high volatility markets because we can keep our risk super low, but we can also have those huge returns like I showed you examples of. And these, give us potential for returns of 100 to over 1,000%, as you saw from those examples. And then step 4, then we're going to get into each strategy. Okay, so we're going to go through when to use, how to use, and the hedging aspects and more of these specific strategies. So we're going to go through buying options, just what's the basic setup for doing just long calls or long puts. We're going to go through the vertical debit spread, using either calls or puts. We're going to go through the long butterfly and the long condor, and again, using calls and puts. We're going to go through in greater detail the calendar diagonal for directional trades up or down, how that works, the specifics of it, and then we're going to go through the synthetic long option strategy, which is just an amazing strategy as well. And then end up with what I call the progressions of hedging, what that is, how you can hedge the different things together using these spreads, and then how, why, and when to hedge. We're going to go through hedging with the condor, hedging with the butterfly, things like that, which is basically what I call matching vertical spreads for hedging adjustments. And then, step by step, how we can do this to actually sometimes we can adjust into free trades. So it's really going to be a great extensive course just on these specific strategies, matching these with the market conditions we're trading and how I do it and the steps involved. You've got a resource page area with what is your assignment risk potential, expiration risk, how that works, auto exercise and assignment, and more on standard deviation comparison and a good trading library. So a really great course with a lot of good stuff in it. And just to finish up here, just to give you an idea of what you're going to get, you're going to get my cycle reversal indicator. Okay, so this is an indicator that's got an upper and lower study. The upper study will show you the reversal when it comes. We can set these up with the reversal arrows here, up or down. Okay, so you can see the cycle reversal is the indicator here, etc. So we'll go through this, how we're going to use that with these chart patterns. And so I've got this for Thinkorswim TradeStation Trading View. So you'll get that. you're going to get, here's a little bit better picture of it. So you can see the reversal here. And so it's a really good cycle indicator. So you can see it came up here way overbought, 90 percentile. We have the reversal here. I'll show you how that works. And then you can see how it kind of finally went down. Here's the cycle reversal up right here. See that? Okay, so it's such a great indicator. We use that. Then I combine that with my momentum indicators. It's a really powerful tool. So here it is, just a quick example of the cycle reversal indicator down below here with my momentum indicators, up here, cycle 1 and 2. So just that combination is a powerful trading system that I've put together. All right, and then you're going to get my extreme range band indicators. So these are helps you to identify price extremes when prices are getting too extended from the mean and they look potentially stretched and looking for a mean reversion. So this is basically what gives us the alert signal for buying and selling exhaustion coming in. So kind of like we got last week. So it's the first signal that a security is starting to reverse, very accurate signaling in advance, potential swing trade or long-term trade market reversal. So I'll pull that up again real quick for you. Yeah, this is what you'll get on that. And we can put up anything. I mean, let me put trying to send you to PayPal. It should go right to credit card. Did you punch credit card? I don't know why it would send you to PayPal. Make sure we will definitely help you out if you still have that problem. You should never have that problem. Just go debit card or credit card. So put your card number in. That's not showing up for you. Debit card or credit card. Let me, sorry for that problem. Let's see. One second here. I'm trying to see all your questions. Okay, try again. If you have any trouble, I'll make sure my Rachel gets back to you, or if you have trouble, we'll get you signed up. I'm not sure what's going on. Really apologies if it should, anybody else have that trouble? It should go straight to credit card if you hit credit card. All right, let me get your information. If you don't mind, I don't mean to make you do anything more. And then I'll also send us an email, support at Power Cycle Trading. Anybody here that needs any help, use this address here. Okay, and then let me get your address real quick. And I'll make sure we get you signed up. And sorry for any inconvenience there. Let me get your address here. Okay, I've got your address there. Okay. Oh. Bear with me. Sorry about the delay here. Anybody else having that problem? Boy, let me get that one out. Hold on one more second. That thing. Okay, we'll take care of you. No worries there. And yeah, let me just make sure I've got all the information. Plus, if you've got any other questions or anybody, send us an email to support at Power Cycle Trading. One last thing here. Okay, so that's the other indicator you'll get there with the course. I mean, these are just add-ons, okay? Extreme range bands, these are when markets hit super stretch. We'll use these to show us potential for buying, selling exhaustion. It's got upper study, the bands. And then when you add the cycle reversal, it's a really great tool for your trading. So this has the cycle reversal indicator below it with the extreme range bands. That's how that we'll use it. So you can see in just this example how it came up here, got really stretched, and then we had a cycle reversal and it started pulling back. Here's just an opposite example down here where it starts to get stretched to the downside. We start getting reversals here, okay? Very stretched, and then it starts reversing back up. Here's another example there. We got a similar situation this last Friday. All right, then you're going to get the Option Masters workshop. So this is a very detailed 6-hour plus course, in 30-minute modules, 360-page PowerPoint of the course. So this is more in-depth, covering the option Greeks, okay? So a really good one to add to the course, because if you need to really go back and understand the Greeks, this is what this course does. And plus it goes through a lot of different strategies as well. Now you're going to get my price target mapping. Somebody asked me how we do those target maps, and so you're going to actually get this as part of a bonus to teach you that in more detail. Okay, so this is a great course. It's exactly how I set my targets for profit or loss targets. And this is a 3-hour plus course that we recorded with PowerPoint and everything, and it goes through the process, which is a combination of using Fibonacci, trend lines, automated moving averages, support resistance, standard deviation, and unusual option activity. So a really great course, but this is exactly what I use for setting out targets, either for profit or stop loss. Then you'll get a 30-day trial membership. And now if you do the alert service, you get this for 4 months. So you'll get access to my virtual trading room, open every day from 9:30 to 10:30 Eastern, Monday through Friday. Come in, ask any questions you have on the trading room or anything you need there. I mean, trades that you might have on, or see what we're doing. Do a daily market video update every day after the close. We do a trading video archive, the archive there. We do live Q&As every week, and these are live and recorded. You get a trader's educational vault, some good educational material that we have in there. And then this should be 50% discount on all courses software on the website. So this is one thing I always like to point out. If you do become a member, you get, this was Jay, and he's been a member a long time now. He said, reading books is fine, but seeing the actual option trade setup makes a huge difference. So that's really what I'm trying to accomplish with the trading room. Okay, so that's what you'll get. Now we'll do a follow-up Q&A. This will be on Wednesday, so this will be part of the package here. We'll have it dedicated for this course, and this will be the Wednesday after that Tuesday night. Okay, so you'll get that. Plus, then if you've got the trading club for 30 days or the alert service for 4 months, you get that access for support as well. The other bonus you're going to get, this is another option course, 60-page option guide course with videos. This is more kind of focused on the Greeks, delta, gamma, theta, option pricing, market maker secret, just more in more detail on that, just so you can understand that more if you really want to go through it. And then just another little bonus here, this is kind of my other type 15 option strategies that you may not understand, or you may want to maybe want a little bit more information on. What is a back ratio spread, or what is a long strangle, short strangle, how that works, what is a ladder spread, it just goes through a lot of different things, ratio butterflies, other things that you may be interested in, but you're not quite sure about. So it's a really good kind of strategy guide there. And then just kind of follow up here with the alert service, just to give you a little bit. I'm going to show you a couple of trades that we did last week on the earnings side that you would get. And this was from one of my members. This was Waleed, who actually lives in Kuwait. He said, have to mention one thing. I'm subscribed to a lot of services who send out trades. Some are good, others are not that great. But one thing I'd like people to understand on this webinar to know is that when I get a trade alert from Larry, I do it blindly. Time has shown me that he is dead accurate on his recommendations. So I really appreciate that. I spend a lot of time trying to select the right trade. So I do, Drew, a lot of time on that. And then here's Dan. He said, very diligent, totally thorough with your analysis. That is the foundation of your success of your alerts. I paid for my subscription with the first 4 trades I took when just learning how to trade options. So that was a really, really great thing. And that's kind of another thing you can do with the alert service. You can kind of follow along. All right, so that's what you're going to get there. And then just one more recap, then I'll show you a few trades, and we'll any other questions, we'll follow up with that, and then call it a quit. Okay, so you're going to get the live course, all the indicators and bonuses. Make sure you use that promo code. You get everything 507. There's a 2-pay if you want it. You'll get access to my 5 alerts over the next 4 months. You can stop and start the alert service, if you need to. If you go out of town, need to take a break. So these will be selective butterfly or condors, selective calendar diagonals, could be a monthly pinning trade or a pinning trade, breakout reversals. These are debit spreads, credit spreads, and selective earnings trades, which I'll show you a couple that we just did last week. So when I send it out, I do a trading guide. A lot of people just do their own thing, but they want the trades. I'll do a setup video review after that night to show you kind of more information why I did the trade. The trades are listed, archived, so you can go back and look at them. We do a weekly live and recorded Q&As, video newsletter, virtual trading room access, and discounts on everything on the website, 50% off on that. You'll get your members code. All right, so when I do send out a trade, I'll give you a selective option trade that I would use, entry levels, profit targets based on the option activity or price target mapping, what option series to use, stop loss and levels and profit target levels. Then I'm constantly monitoring the trades throughout the day, to tell you if there's anything needed, if you need to do adjustments, anything like that. We use a system called Telegram, and the Telegram sends these trades out within seconds, okay? So here's, what it'll look like. You'll get this Telegram, and it'll just, as soon as I send the trade out, you get it. So here's, like, for example, I'll show you in a minute. We did this Exxon Mobil trade. This was an earnings trade. And then the next day, send out, okay, go ahead and take profit on that. Here it is, the calendar, take profit. So just very, very detailed stuff. And I'm constantly updating if I need to. And then you have access to the trading room every week during the day, during the week, 9:30, 10:30 a.m. Eastern, and discounts on everything on the website. So here's just a couple real quick to finish up to let you see what potential is here. These are a couple earnings trades we did last week. This was from KG, one of my members who just loves earning trades. He said, I made a lot more than 1,200 on my first trade, Larry suggested in text. Great price traders, well worth the investment. So here's just a quick update summary on the earnings. These are very, very selective that I send out. So we've had 144 closed out, 105 winners, 17 break even, 22 losers, running 85% winning rate on these trades. These are unaudited. So here are 2 that we did last week. We did this one. This was on Exxon Mobil. This was what I called my double lightning, and we set this trade up on Thursday and took this trade off on Friday. So this was a double calendar. So very selective trade. Go through exactly how to do it. It's very, very detailed on this trade setup. Sent this out about an hour and a half before the close. It was sent out at 1:13 p.m. So you have plenty of time to go through it. But it shows you exactly how to set the trade up here. All right. So it tells you exactly how to do it. And the next day, we had it going where we wanted it to. So this was then trading around, this is the wrong number there, but I said if you're long the double calendar spread, long that 113, the 110, then go ahead and take profit on the trade. It was up $45 per spread. So this was a really cool trade. This is one specifically designed for volatility crush. So set this up, the double calendar, double lightning, I call it. So Exxon, Thursday before the close was 98.15, set the trade up for expiration the next day. And when it was going out at 111.06 right here, this is what that trade setup looks like. So it was right there, right where we want it, right in the sweet spot. So this trade we set up, you can see the total cost on the trade was $118. The spread blew to 175 with out at $57, 48% return. So you can see the call side of it. We had set up, that leg was for 65 bucks was our cost. The other leg, the put side, was a cost of 53. So there's their total cost there. And then that call side blew to 79, put side blew to 96. So that's how that works. So this is specifically designed for earnings. And so that was why that was done last Thursday. And this is another one we did specifically for earnings. This was on Carvana. This was set up on Thursday. It was trading at 337.46, and this was for a big price spike up or down, and took this off on Friday. We actually had profit take on Thursday and also did Friday. So trade blew out to 377. This was actually up to $400 at one point. Just an incredible trade. So this is what we did here. Set this trade up here on Thursday for this potential big price spike right there. Big spike up. Look at that. Went up to over 410. Took some profit there. Took it out there if you had any left. So this was a max profit trade, specifically designed for price spikes. And so this was what that trade looked like going out right there. So this was max profit. Our cost was 190 for the spread. Spread blew to max profit there of 250, so 60 bucks. Again, these are specific for earnings. Okay, so that's just what we were doing last week, a couple of those. And then here are a couple other, here's the calendar diagonals that we've been doing. These are, again, we do a lot of these. You can see from June 2019 to current, we've done 353 of these. 252 winners, 24 break even, 77 losers, running about a 78% win rate, unaudited. And these are designed for a little longer term swing trades, either up or down. All right. So here's one that we did on KRE, the 27th of June. And I won't go through the detail too much, it's kind of a lot. But this was a very interesting trade that we did a number of different adjustments on, and ended up adjusting the price down to like 8 cents or $8. Okay. So pretty cool trade. So we set it up here, did these adjustments and profit take. So this actually ended up making over a 1900% return based on the adjustments that we did and how it reduced our price. Okay, so we ended up with this long the 62-64 called debit spread, and then ended up with the short 65-67. So we had this condor like this, and we had reduced our price with the adjustments down to 8 cents on that debit cost there. So $8 spread with the 200 in here, $192, 2,400% return potential, and ended up with pretty good profit, really good return. So here's where it went out. We took it right in there. You can see right there. So this went, now at that point it was trading at 63.95. Okay, so the spread went from $8 to 161. So this was up 153 per spread. Okay, we're legging out, but that's how that spread was designed. So this made a 1900% return on that adjusted calendar, which was adjusted to the condor. And here's another one. This was another one that we did on Dell. Okay, so this was a long call counter diagonal on Dell that we set up on the 18th of June. It was trading 117. Long story short, on the 20th, we did an adjustment. It was 118.77, had some profit there. On the 25th, it's 207, up 828% return. So here's where it's set up. You can see my indicators. This is what we're using: momentum, cycle reversal, breakout right there, adjustment, profit, bingo. Okay. So these are all alert trades. One that I don't have on it, we did last week Amazon. I meant to put that on here, but forgot to put it on. We did Amazon condors. So that's a look there. So Dale, the initial trade we had on for 310. We did some profit take. Then we did the adjustment here. We're up 52 bucks. Then we did an adjustment and adjusted this into a long call condor. So again, this is what you're going to learn in the course. The condor is such a great one because we do a lot of different adjustments we can do. So ended up with this trade into a condor right here with that 116, 119 and sold the 124, 127 against it. So this went from a call counter diagonal to this condor, and we reduced and adjusted down our price here in this trade to 25 bucks. And then the spread width 300. So we had a potential for 275, over 1100% return there. Potential. Okay, always look at the risk reward. That's how you back in to know if you want to do the trade. And so ended up, it's going out right here. Profit right there. Not perfect, but close enough. That was on the 25th. And so the spread blew from 25 up to 232. So it was up $207, 828% return over that period. Okay. So that's a look there. And then here are a couple others. Here's the butterfly long condors. Now, we've had really great success with these as well. So we're running about 80% win rate. These are very low risk trades, 50 bucks average. If you look at the average loss, potential profits are 2 to 1, 25 to 1. Since starting this back in May 2019, we've had 234 closed out, 169 winners, 18 break even, 47 losers. So unaudited, but just pretty good win rate there. Here are a couple examples. Here's Palantir, one that we did. We just did one on Amazon. I should put that in. But here's Palantir. We did this on the 13th of May. It was trading 123. 16th took it off as up to 128.88. And this is, set up right here, out here. See, exact same pattern. These patterns are what you'll see in the course as well. And so here's the trade. Here's what we put on. Now these are sometimes we'll put on just exactly as the condor, but sometimes we'll leg into them. But this one we did as just a pure condor. So 125, 127 called debit spread side, and then it sold the 136, 138 against it. So this is what you're going to learn in the course, okay? And so we had a total risk on this trade of 72 bucks going into it, and potential profit spread with a 200, potential profit 128. Chipping away at potential for 177% return, and ended up max profit there. Went out right where we wanted it to go out. So it was went from 72 to 200, up 72 bucks. I mean, up 128 right there, 177% return on that. And here's just one more here. This was the SPY put condor. And this one is one that we adjusted into. So I'll just kind of go through this one quickly. But this was on the 10th of March. It was trading at 568. And then on the 11th, I already showed you this one earlier. So we'll just kind of flip through this. But this was a really great setup that we did. And then here are a couple other lotto. Here's another one that we call these lotto trades. Here's another one that we did a penny trade on SPY. This was an alert trade. And so this one was perfectly set up as well. This was on the 6th, and this was a penny trade that we did. It was trading at 573.88. We set this trade up. I said set it up for $40 or lower, okay? And so then this was on the 10th was going out. This was now up $561, was trading around there. It was up $232 per spread. It was up 590% return on that going out. Okay, so this was a butterfly penny trade, set it up here, targeting there. And so here's the profile of the trade. So we were long, we set up looking to pin at 560. So I had the 565, 560, 555, entered the trade, cost $39, spread width 500, potential 461, potential to make over 1100% return on a pin. And here's where it was going out right there. So pretty close right there. So it's going out right here at 560. And so it was right there. So it went from 39 bucks to 456 bucks. So this was up $470 per spread, 1,069% return on that right into the close. Again, we're, you scale out, but you try to leave a little bit right towards the bitter end. And I showed you this one earlier, so we'll just flip through that. That's the Tesla. Okay, so that's pretty much covers. Hopefully everybody got a great idea of the potential here, and we'll, start the course next weekend. And again, here's the link. Make sure to join us and take advantage of that promo code here. Make sure you put this special link in and then type in OP15. And I'd like to say again, thank you everybody so much for being here. Appreciate the time you spent with me today.